Everyone, Ahmet here with Down to Trade. Welcome back to our channel where we take a deep dive into the dynamics of trading. With me again is the Varian Croft. Varian, how's it going, buddy?
Doing awesome, man. Happy to be here.
Absolutely. So today we're diving into kind of a powerful trading approach that cycles through selling puts and to buying shares and then selling calls. We call this rotational trading, but some might call it the wheel strategy.
Yeah, this isn't just a strategy. It's a systemic approach to generating income, while managing your risk.
Right. I 100% agree. But I want to kind of break it down. So rotational trading, for those of you who don't know, rotational trading, or like I said, wheel strategy, starts with selling put options on stocks that you'd be comfortable owning or stocks that you want to own. And it's kind of like saying, I want to buy this stock, but at a lower price. And I want to get paid while I wait for that price. And so that's the whole idea behind it.
Yeah, absolutely. But if the stock price stays above your strike price, and the puts expire out of the money,
Mhm.
then you keep all the premium and then just repeat the process. It's income in your pocket without ever owning the stock.
Right. But that's actually where it's kind of cool, right? This is where it gets interesting because, like you said, if price goes up and expires out of the money, we just pocket the premium and we don't own the stock. But if price goes down, if the stock actually dips below our strike price at expiration, the puts expire in the money and we get assigned the shares. And remember, that's not really a loss. That's part of the cycle. That's part of our plan.
Yeah, exactly. Owning the stock is the second phase of the strategy. It's really what you want. But the advantage is you made some premium while you waited for the price to come down to where you wanted to enter. Now it's, once you're in that, now it's time for covered calls. You own the stock, you sell call options against it. It's another way to generate income, this time from a stock you own.
Exactly. But where are we selling these calls, you might ask? Well, obviously, when you're selling those calls, you want to aim above market price, ideally where you kind of foresee resistance or a price that you'd be comfortable selling the stock. So this pretty much maximizes your profit potential while providing that downside protection that we want.
Yeah. So, and if the stock doesn't reach the call strike price by expiration, you keep the stock and the premium, then rinse and repeat.
Exactly. So like you said, if the price doesn't reach your call strike price by expiration, you just keep the stock and the premium and you move on. But if if you if your shares get called away because the stock rises above your call strike, well, that's really a win-win. You sold at a profit, plus you collected premium along the way. So let's actually take a look at a chart and see what that might look like over time. So, okay, so this is an example of a cycle. This is not a real world cycle. I didn't look at actual premium prices or anything like that, but this was just an example I wanted to throw together of what the cycle might look like over what a 5-month period, give or take. And in this example, we were looking at Intel. We liked Intel. We decided we want to buy Intel. But on the day that we were looking at it, which was November 1st, we didn't want to buy it for $36.89. We wanted to buy it for $33. So we sold puts against it. We sold the $33 put strikes against it, and we collected $1 premium for that. Obviously, price continued up, so we get to keep all of that premium, and we just rinse and repeat, like Varian said. After expiration, we sell more puts. This time we sold the $40 puts again for a $1 credit. Price continued up, so those expired worthless. On January 2nd, we sold the $44 puts again for a dollar credit. And this time the puts expired below our strike. So we actually get assigned those 100 shares of Intel at $44. And again, immediately we sell covered calls against this. And so we sell the $48 or the 48 strike calls against this, and we collect 80 cents, let's say. And obviously those expired out of the money. And so next time we sold the $49 calls. And again, those are so far again out of the money. Those have not expired yet. But this is what the cycle typically looks like. Again, these aren't real world examples. These aren't real premiums, and these aren't actual dates that I would consider buying and selling or selling for this strategy. But I just wanted to show you what the cycle might look like over time.
Yeah, man. So the big question is, which stocks should you be looking at? This is an important question. And I, again, would first consider if the stock is something I want to own.
Right. Absolutely. And again, I yes, that's very, very true. Is it something I want to own? But also, I'd be looking for value stocks. I'm not going to be looking so much for growth stocks. And so when I'm considering value stocks, I obviously people typically will consider PE ratio, price to earnings ratio, but also are they consistently profitable? Do they pay dividends, right? And the reason dividends are important because let's face it, growth stocks aren't really paying dividends.
Yeah. And you should also consider their chart.
Yes.
For instance, I might consider a stock that is running sideways and ready for a bounce at the bottom of a channel.
Mm-hmm.
For instance, Intel in the chart that you were showing now
Yeah.
is a value stock that is
Yep.
slightly showing signs of a possible bounce at the local channel.
Yep.
Now, I'm not saying to run this on Intel right now. I just want to give you, this chart as another example of something like what I would consider. So Intel is a company I certainly like to own. It's a value stock. It's
Mm-hmm.
profitable. They pay dividends, and they're possibly setting up for a bounce.
Right. And so I guess the next question that would someone would ask is what expirations should I be looking at? And this is actually one of the great things about the strategy. It is income producing. It's an income producing cycle that is very easy to manage and can be entered in several different ways depending on your preference. Some traders take expirations only 1 to 2 weeks out, while others look for expirations 1 to 2 months out or even more. It really depends on your anticipated time horizon for the stock. And that's actually what I really love about this strategy is you can tailor it to how you want to do it. So I guess the next question would be closing. What do you look for in closing?
Well, I mean, like you said, you can run the strategy to your liking. Some traders will take profits at 80% premium capture,
Mm-hmm.
while other traders, they let it run to expiration. But remember, the goal of the first phase is to eventually get assigned. So when it does go against you and you get filled on your shares, that's when you want to move to phase two, covered calls. And also remember, you picked a stock that you want to own long-term at a price that you felt was fair. This rotational trading isn't gambling, it's a strategic positioning. It requires patience, understanding, and timing.
What a great point. I love how you said that. It requires patience, understanding, and timing. Absolutely. Well, and like we said, the strategy is easy to manage and make adjustments to. And as you alluded to, the beauty of the strategy is its flexibility. So yes, I love the strategy, and I encourage traders to continue to study and continue to learn more about it. But that said, I think we'll leave it here for today for the strategy, and perhaps we'll cover it in greater detail in a later video when we have more time. But for now, Varian, what do you have for us in the backtest lab?
All right. So this strategy decided to do a little bit different. We had been doing a lot of stuff on the SPX. This is a strategy on the SPY. And it is a play, something that can be done over the weekend. So you would enter it on Friday and you would close it out by end of day on Monday.
That's interesting.
Yeah. So just thought it was something unique that we could take a look at. And what we're doing here is an iron condor
Okay,
that you are selling 3 days out and you are buying 5 days out.
got it.
And you can see here on the put side, you're selling the 45 delta. And on the call side, you're selling the 15 delta. And then what you're doing is you're actually just going 1 point. So if you're selling the 400, you're buying the 401. So this is
Right.
literally on the SPY, it's only $1. So on each end, you're just going 1 point out, but you're doing those 5 days out.
Right.
And as you can see here, you enter the trade at 3:50 p.m. On Friday. And again, this is just based on one contract to give everybody a just base idea if you're doing one contract on this. And there's no actual profit target set. You are just closing it out the following day at the specific time, which is 3:45 p.m.
Okay.
So as you can see, it's got an 88% win rate. And the cool thing about this that I really liked is during times where it is not working as well, you can see the max drawdown on this thing is only 0.1%.
Nothing.
Yeah. So, you're not looking at big winners. This is that little base hits.
Right.
The average winner is only $45. The average loser is $55. But you can see what I liked about this is over the past year on this, nice and steady up. And then during a difficult time, it is just going sideways. You're not getting huge drawdowns on this.
Right.
It just goes sideways. So yeah, you're not winning, but you're not really losing either.
Right.
And then we've gotten back into a period where it's functioning again.
And it's almost akin to our day trading style, as far as let your winners run and let your losers take your losers off quickly.
Exactly.
It's kind of runs the same way. So I like it. I do. So a huge win rate, pretty much a 1-to-1 risk reward. Your expected return is $34. And like you always mention, is very scalable. You always do it with only one contract. So we know what the base numbers are. But the truth is it's scalable. So if you're looking to make $340 over the weekend, you could do this with 10 contracts instead.
Exactly.
I've noticed you are really liking these double diagonals.
Yeah, I've been finding a lot of benefit in them.
Yeah.
So especially in, the market conditions we're playing around with right now, just trying to find some of those really unique because everybody's out there doing the basic, credit spreads, debit spreads,
Right.
the occasional butterfly, things of that nature. Those are very common. But what I'm finding is that the ones that are a little more intricate like this seem to be having better win ratios than a lot of the, I guess, the simpler stuff out there. So just really wanted to explore some of the more in-depth possibilities of what can be done.
Well, in the past, in previous market climates, no one really needed to do double diagonals because everything else was working.
Yeah.
Now that the market has kind of shifted, and we've discussed this many times, now that the market has shifted and some of those less nuanced strategies are not working as well as they used to, you and I have found, and you've shown this time and time and time again with your backtest lab, how some of these more intricate strategies are still working fantastic relative to, like you said, some of the older strategies that are kind of going the way of the dodo bird. They still work and they're still great strategies, but they're not as effective as they used to be. Let's put it that way.
Exactly.
Okay, man, I like this. Could we see the trade log real quick just to take a look at the first one or two trades, just to kind of get an idea of what's going on? And again, you said you're not setting a stop loss, you're not setting a take profit, so all of these are going to exit at 15 minutes prior to close on Monday morning. Or I'm sorry, Monday afternoon.
Exactly. So as you can see, all of them, because of the 3-5, 3-day expiration, 5-day expiration setup on it, only being a dollar wide, the majority of them are you're going in for a debit. And then closing the next day at 3:45 and receiving more than what you paid when you got in.
Yeah, I would agree. Like I said, 10 contracts, easy way to make $340 every Friday.
Yeah.
Or every Monday when you close it out. I like that, man. Well, once again, great job with the backtest lab, dude. Look, we're always excited to try out new and exciting strategies. So thank you, Varian, once again.
Absolutely.
As always, if you'd like to learn more, or if you'd like to see how we use these and other strategies every day in our day and swing trade rooms, I sincerely, I invite you to try out our membership for free. Just go to downtotrade.com. And right now we still have some great promotions running. So you don't want to miss out on those. Again, just go to downtotrade.com. That's down the number 2 trade.com. If you like this content, do us a big favor and subscribe to our channel. And don't forget to hit that like button. We'd love to hear your questions and thoughts. So please take a moment and leave us a comment down below. Other than that, thanks for tuning in. That's going to be it for me. Varian, do you have anything else?
Nope, just come check us out.
Yep, that's it. Okay, everybody. Until next time, this is Ahmet and Varian reminding you to learn it, trade it, and profit. Take care, everybody. Happy trading.